You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
Welcome to the Options Playbook, the program where we break down cutting-edge option strategies and explain how you can incorporate them into your own portfolio. Whether you're looking to grow your capital with some offensive maneuvers or protect your investments with defensive plays, you can find them all in the Options Playbook. The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities LLC, member FINRA and SIPC. Now, let's open the playbook and get started.
Welcome to Options Playbook Radio. I'm your host, Brian Overby, Ally Invest Senior Options Analyst and author of The Options Playbook. Well, we're getting to the end of earnings season, but we do have a big price stock that's going to be announcing earnings here fairly soon. The stock that we're going to look at today is Priceline. Symbol is PCLN. Right now, we're taping Options Playbook Radio on the 21st. It's a Wednesday. It's after the close. Priceline today was at 1,880.68. There's a lot of eights in there, so 1,180.68. It was down $13.94 today. Now, we're going to look at skip strike butterfly and Priceline, and we've looked at these type of trades in pricey underlyings. They are quite interesting when you think about the dynamics or the premium, more importantly, that is brought in just because the underlying is basically trading at the same value as an index. I mean, it's fairly close to where the S&P 500 index is at. So we have an $1,800 stock. We have an earnings that is coming out, so implied volatilities are juiced in them, and we do expect a volatility crunch after the fact. So not meant to be a recommendation as always, but when we have these type of situations, this is when we like to talk about the dynamics of how time decay and delta and theta all work together as earnings get announced, expiration approaches, implied volatility comes in, and that's when some of these trades are interesting. Now, you can be volatile. A skip strike butterfly is a trade that we're going to look at, and if you want to follow along at home, we're going to look on the call side. So we're going to look at a skip strike butterfly with calls. That's page 108 in the Options Playbook. A lot of times it's referred to also as a modified butterfly. I like skip strike better as a name, and that's mainly because we are actually skipping the strike that we would normally buy, and we are embedding a credit spread inside the butterfly to help pay for the butterfly. I've also heard it called a broken wing. I've also heard it called a split strike butterfly. So with that said, let's jump right into the trade, and then we're going to talk about it. Our whole goal here is that we do want to get this entire trade done for a net credit. That is our whole goal with this underlying. So anytime we're going to do an earnings, what we first want to start out by doing is looking at the most at-the-money straddle. Get what an expectation of what the marketplace thinks may happen after the earnings announcement. So as of right now, my data is showing me they're anticipating announcing earnings on the 27th, which is 6 days away. But we're taping Options Playbook Radio on this Wednesday. I'd prefer to be a little bit closer to the actual earnings date. But bottom line is, as we tape the show when we tape the show. So with that being said, we're going to still trudge forward and look at this potential trade. Now, this is one thing that's kind of crazy about Priceline and being such a high price stock is that the at the money straddle is trading for 132 and some change. So we're going to say 132 points to the upside or to the downside is the range or the expected move that the marketplace is implying or putting in to this underlying. Now, as far as volatility is concerned, the implied volatility of the March expiration, March 2nd. Now, remember, they're announcing on February 27th. So they're announcing on a Tuesday. March 2nd is a Friday. They're saying the implied volatility right now is about 54%, expecting, let's say, a 130-point move, 54%. Now that we know that information, we can go on out and try to pick our strikes. On a skip strike butterfly, as I mentioned earlier, we are embedding a credit spread inside a standard butterfly to help pay for it, which means that we are also embedding risk into the trade. And because of that, we want to get as far away from where the underlying is right now. And that's where that credit spread is going to reside. And we're hoping that it never gets there. So we're expecting the market to move the expected move or less, not more. That's the goal of this strategy. We're looking for it to move less than the marketplace is implying it may move after earnings. So that means we're going to do it on the call side. You could do it on the put side if you'd like. If I'm going to do a smaller move, I'd rather go to the upside normally, just because stocks have a tendency to go down with more velocity than they have a tendency to go up. So when I'm expecting less of a move, I'm going to go to the call side. I have no idea or opinion on what Priceline's earnings are going to be. I'm just looking at the scenario and trying to come up with a trade based off of all the dynamics of the options pricing inside of Priceline. Okay, so what do we first have to do? We have to take our little handy dandy calculator or do the math in our head and say, okay, right now the market is at 1,880. The expected move is approximately 130 points. That puts our strike somewhere around 2,010. So we want to be higher than that if we possibly can and still get this entire trade done for a net credit. So I already have a trade set up here. I was looking at the quotes before we started taping, and I see we're looking to, where we could actually go all the way up to the 2030 strike call, and we're going to go 15 points wide on our skip strike butterfly, and we can get this done for a net credit. Now, all this being said, we're looking at trading at the midpoint on this. Bid-ask spreads are wide, particularly because the markets are closed right now. But on expensive underlyings, you have a tendency to get a little bit wider bid-ask spreads just in general in the options marketplace. So here's the trade, if you are ready. We're going to do the nearest term expiration to the actual earnings, which is March 2nd. We are going to buy the 2030 Priceline call with the March 2nd expiration. We're going to sell two 2045 Priceline calls with the same expiration. And then we are actually going to skip the 2060 call, which would normally make this just a standard butterfly. And we are then going to buy the 2075 call, which is trading for much less than the 2060. And we're going to get this entire trade done for a net credit of $1.50 to the account. Now, that's at the midpoint. Now, no guarantees that we're ever going to get a midpoint fill. And you always got to think about commissions when you're doing multiple leg trades. So what's our risk? What's our reward? What's all involved with this trade? So if we have this trade on right now, our risk comes from the fact that we skipped that 2060 strike and bought the 2075 strike as our protection instead. So that's 15 points wide. From 2060 to 2075, that's the credit spread that is helping us pay for this butterfly, basically, that we would like to have on. So that's 15 points, and for every 1x2x1 skip strike butterfly, for every unit that we do, it's going to be 15 times 100 or $1,500. Okay, that is our max risk for every 1x2x1 skip strike butterfly. For each one that we do, we add another $1,500 of risk on. Now, we did receive a credit, hopefully, when we put this trade on, of $1.50. So you can use that credit to help manage your risk, of course, but that $1.50 is what we put the entire trade on. And that's one of the things that's very interesting about a skip strike butterfly is we are doing this as a net credit trade to the account. So if earnings are announced and the stock doesn't move or the stock goes down and all the options expire worthless, we get to keep that credit of $1.50. Now, the perfect scenario here is that the market, they announce earnings, the market starts going up, and it slowly starts going up towards our strikes inside our butterfly. And the absolute best case scenario that could ever happen is that it slowly did that, and right at the expiration date, it stopped pegged at our short strike, at the option strike that we sold, and that would be the 2045 strike call. Now, if you never got out of the trade, you rode that all the way to expiration and it landed right on that, well, once again, you'd be getting the stupid award because you should be out of that trade before it ever happens. And also, if you're ever doing this trade, if you see that underlying getting above the 2030 strike call, the first call that you bought, you want to think about just getting out of the trade anyways. Anywhere near the 2045, you're out for sure. You're not going to take that 15-point risk of that short call getting in your way. Okay, so that's our outlook. We're buying the 2030, selling 2 of the 2045s, and buying 1 of the 2075s. Now, we are doing this trade hoping that the market will only move the expected move. If it goes to the upside, if it goes to the downside, who cares? No worry, we're going to make our $1.50 credit for every skip strike butterfly that we put on. But we also have to realize that we do have this risk that credit spread that's embedded in the butterfly is causing us on this trade. So I will say this with Priceline, and it's mainly because it's an expensive stock. It's really nice that we can put this trade on, and the first strike that we're buying, the closest to the money option contract, is 20 points above the expected move, right? We were saying that our strike would be about 2010. We're able to buy the 2030 strike call as the first call or the first leg of our skip strike butterfly. So that even gives us a little bit more leeway on this trade. Now, I do not want the market to open up right at 2045 after they announce earnings. That's not good for this trade. You want it to slowly go on up. It could open up 50 points, 60 points, 70 points higher. That's fine. I just don't want it to move the entire move, which is 130 points on the open, on a gap open, because that can raise havoc in this trade. And it's mainly because we're looking at this trade. They're going to announce earnings after the close on Tuesday. So you still have Wednesday full day trading, Thursday full day of trading, and Friday full day of trading. So there's still some premium that's going to be left in this option contract after they announce earnings. There's still going to be some value just because Priceline is such a high price stock. I would rather have Priceline announce earnings on Wednesday or even Thursday. Then I find these trades more interesting. But to be blunt, we might not get as much of a credit on this trade with the same strikes if we were doing this trade with Priceline announcing earnings on a Wednesday after the close or Thursday after the close. So we'll look at this. This trade has a little bit of life in it, and we'll come back next week, and we'll be able to see what happened after they announce earnings, because they'll be announcing earnings on the 27th, which is a Tuesday, and we normally tape Options Playbook Radio on a Wednesday. So that's it for this episode of Options Playbook Radio. If you have a topic you'd like us to discuss on the show or a question you'd like us to answer in the program, you can send them directly to me at theoptionsguy at invest.ally.com. That's theoptionsguy@invest.ally.com. Thanks for listening. We'll be back at the same time, same place next week. Until then, may all the options you bought finish in the money and all the ones you sold finish out.
The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities LLC, member FINRA and SIPC.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.